we're going to touch a bit on life insurance as it relates to mortgages, and because you also do life insurance.
Yes.
So just as a quick basic.
Yeah, so as I said before the break, a client has an option to either accept the creditor life insurance through the lender, or they can opt to purchase their own insurance. Once it comes to life insurance, and as a licensed agent, I basically show the client, their options once it comes to life insurance. There's basically two types of life insurance. There's temporary insurance, also called term insurance, which is the lowest cost insurance. And then there's permanent insurance, which basically is with the client for the rest of his life, which is more expensive than term insurance. Now, there's pros and cons to both term insurance and permanent insurance. So I basically assess a client's situation and explain the two options, and let the client decide which type of insurance they want to purchase, whether it's term or permanent insurance. Usually with younger couples that are just starting out, and let's say they're buying their first home and their budget doesn't allow for a lot in terms of a monthly premium on insurance, usually they opt for what's called term insurance. And term insurance is for a specified term, whether it's 10, 20, or 30 years, and the premium is fixed for that term. And once it comes to insuring a mortgage for a young couple that's on a tight budget, term insurance is probably the best way to go, because then they can maximize the amount of insurance that they purchase for the amount of premium that they're going to be paying. On the other hand, if a client wants to look at a permanent type of insurance where they're going to have insurance for the rest of their lives, and they know that they can afford a little bit more on a monthly premium for insurance, it's a good thing to get into a permanent insurance policy at a young age, because you'll be paying that amount of premium for the rest of your life, as opposed to term insurance where you're paying a premium for 10 years, and then 10 years from now you might want to renew the insurance for another 10 years or 20 years, and the premium is going to be that much higher because you're older at that stage. So my role as a life insurance as well as a mortgage agent is to explain the different types of insurance and the different options that people have once it comes to purchasing insurance. But bottom line is, I strongly advise my clients to purchase any type of insurance once it comes to insuring your mortgage and basically insuring your family and protecting your family when you have a mortgage.
So do you, this might sound kind of basic, but if a mortgage is 25 years, the amortization period, do you sell the insurance period to match that, or is that not necessarily?
You can. It's a good idea for someone who is on a tight budget, but yet they want their premiums to be fixed for as close to the amortization period as possible. So usually with term insurance products, you can buy like a 20-year term. Some of them have 30-year terms, and I mean there might be some companies where you can buy 25-year, but it's uncommon. Yeah. Usually the common terms are like 10, 20, or 30 years. So we can match the term of the insurance to the amortization period of the mortgage.